everyone, I'm Dr. Durdana Oways from Department of Commerce, the Bhopal School of Social Sciences. The agenda for this video lecture is pension plans. When young, most of us are in a spending mode and less concerned about saving and investment. But at this time, when there is increasing wealth and improved healthcare have considerably improved our average lifespan, a lack of foresight among young Indians may represent a significant challenge. Take a look at this news. The news dated October 20, 2020 said just rupees 11.57 lakhs to retire. Survey shows that young Indians grossly unprepared for the old age. A survey conducted by Reserve Bank of India committed a few years ago showed that most Indians do not have a retirement plan. Many in India are still dependent on their children. That was a case in the past, and so it is even today. Just look at another piece of news. Half of urban Indians have no retirement plans. India may be one of the world's youngest countries now, but in 30 years it will have a huge population in the retirement age. And given how few people are planning for retirement, a perfect storm is brewing up. And this news is a perfect example of that. This is mainly due to the lack of awareness that is hampering planning. Many feel that retirement is a very vague concept, and even if they want to plan, they do not know where to start and how much to save. So in this video lecture, we are going to understand what are pension plans, and the topic covered will include introduction, features, types, benefits, and why we should opt for pension plans. Now, let's understand what is meant by a pension. A pension is a retirement fund for an employee paid into by the employer, employees, or both. As a fund, it aids individuals in saving a part of their income over time in order to improve their financial portfolio in the future. Even if a large sum of money is saved for the future, the best retirement plans are crucial for everyone. Moreover, pensions are payments that are made to retired workers of an organization in the form of annuity over a certain length of time as compensation for the previous employment with the organization. We can also say that a pension plan is actually a retirement plan that requires an employer or employee to make contributions to a pool of funds set aside for a worker's future benefit. As such, this retirement amount that an individual receives from their company or even insurance company, they get that on a monthly basis or in a form of lump sum. Moreover, there are future benefits also with this retirement plan. That is, through these retirement plans or pension plans, it is possible only through continuous investment. One may build up a significant fund that, when it matures, will provide a person with regular monthly income that will cover your post-employment period. Now, basically, we can say that a pension plan is based on the philosophy of paying yourself first, which is often the first personal finance lesson that you will learn. It symbolizes saving for the future as well as securing your future, and it has got the following features. The first feature includes guaranteed income. Depending on how you invest, you can receive a guaranteed or consistent income after your retirement. Your second feature includes tax efficiency. Some pension plans also provide tax exemptions under the Section 80C. If you wish to invest in pension plan, then Income Tax Act 1961 offers significant tax respite under Chapter 6A. Third is liquidity. Some plans permit withdrawal even during the accumulation period. This will guarantee that the money is available to the individual in the event of an emergency rather than having to rely on bank loans or any other source of funding. Fourth is vesting age. Another feature of pension plan is vesting age. This is the age at which you will begin receiving your monthly pension. Most pension plans, for example, have a minimum vesting age of 45 to 50 years. That is flexible up to 70 years, while some business allow vesting at the age of 90. Your next feature includes accumulation duration. This is an investor can opt to pay the premium in installments or all at once as a lump sum investment. This money will grow over time to form a significant corpus that will include investment as well as gains. For example, if you begin investing at the age of 30 and continue to invest until the age of 60, this is your accumulation duration. Your accumulation period will be 30 years. This corpus is principally responsible for your pension for the set term. Then comes your payment period. This is the time after the retirement when you receive your pension. For example, if one obtains a pension between the age of 60 to 75, the payout duration will be these 15 years from 60 to 75. That is called as payment period. Most plans split this from the accumulation phase, while others allow partial or full withdrawal during the accumulation period as well. Then comes your surrender value. This is the value that you will receive if you surrender the policy before the completion of the term. Now, having seen the features, let's understand the types of pension plans. These are the types of pension plans that are available in India. The first one is deferred annuity. People are looking for smarter ways to invest and manage their retirement saving. Annuities have always been popular as they offer guaranteed income to the investors. They also provide a way for long-term savings. These are a kind of insurance plan which offers an individual to save for long term. A deferred annuity option often requires an investor to build a corpus. The life insurance companies and then promises to pay the insurer a regular or lump sum amount at a future maturity. These deferred annuities, you can purchase them by a one-time payment method or through a regular premium payment method. These also have a benefit of tax exemptions up to a limit like any other insurance plan. Moreover, there are several different types of deferred annuity: fixed, indexed and variable, which further determines the rate of return that you will be getting. As the name suggests, the fixed deferred annuity promises a guaranteed or fixed rate of return. Indexed annuity is based on the market index, and variable annuity is based solely on the portfolio of the mutual fund performance or other account that is chosen by the owner. Now, deferred annuities are also fixed or locked and are subjected to changes at the time of early withdrawal. In case you withdraw before the maturity date, then tax penalties of 10% is applicable. Then comes immediate annuity. Immediate annuity is also kind of life insurance premium pension plan that promises to pay a series of annuity payments throughout your life. You also have an option to for a joint life pension annuity plan wherein the funds or the annuity payments are available even during the lifetime of one's spouses. Then comes certainty annuity. As the name suggests, the insurance company provides a certain annuity. These are retirement income investments which gives the owner or nominee a guaranteed retirement income for a set length of time. A lump sum annuity payment is also an option, and these annuities generate larger returns than any other annuity option due to the fixed expiration date. When compared to other regular annuities, these feature higher upfront cost and extra expenses. Fourth is with cover and without cover pension plans. With cover pension plans means that the life of the policy holder is covered, and upon his death, a lump sum amount is paid to the immediate family member, also known as the nominee. These plans are like a typical insurance plan, but the amount that is paid under these plans is not considerable. Now, when we talk about without cover pension plans, these are the ones that do not cover the policyholder's life. When the policyholder dies, the candidate receives the corpus that was created during his lifetime. Then comes guaranteed period annuity. As the name suggests, the guaranteed period annuity is an annuity that offers guaranteed returns. This type of annuity ensures that the immediate family members of the annuitant are benefited even after the death of the policyholder throughout the entire period of the guarantee of the annuity. Then comes life annuity. This is the most common type of pension plan, and under this plan, a policyholder or an annuitant is guaranteed a life pension annuity income throughout his life. It also provides the option of joint annuity, where the annuity is paid to the spouse even after the death of the policyholder. Then comes life unit linked insurance plan. Life unit linked insurance plan is a single integrated investment plan which acts both as an insurance plan as well as it provides life protection also. A part of the funds invested in these plans are used to provide for life insurance, while the rest of the amount is invested in equity or debt funds. Unlike regular insurance policies, these programs are subjected to specific fees. The return on these unit-linked insurance plans, on the other hand, are fully dependent on market circumstances, and the risk of investing is solely carried out by the policyholder. Then comes defined benefit pension plans. This type of a pension plan is one where a specified pension payment or a lump sum or a combination thereof is paid to the employee by his employer or the insurance company. These are actually employer-sponsored retirement plans, and the benefit for the employee is computed taking into consideration his age, earnings, tenure of service, etc. And it includes joint contribution of both the employees as well as the employer. The income under this plan is generated based on solely the contribution of the employees. Next come defined contribution pension plan. Defined contribution pension plan requires one to contribute to their own money towards a retirement plan. Here, both the employee and the employer makes contribution on a regular basis. Next comes National Pension Scheme. National Pension Scheme is basically a scheme that is provided by the government. It is one of the significant steps that is taken by the government. The scheme was initially applicable only to government employees, and later on it was open for all the citizens. The scheme was basically introduced to protect the interests of the individual's post-retirement period. Due to its tax-saving benefits, NPS has become quite popular as an investment option too. And last is the pension funds. Pension funds are another type of retirement pension plans which are popular among, again, young investors, and these funds usually have a large amount of money invested and the returns are also higher as compared to other retirement plans. Now, after seeing these all types of pension plans, the basic question comes: why opt for pension plan? The first reason to opt for pension plan is, first and foremost, a rise in life expectancy rate. Life expectancy rate as recorded in 2017 in India was 68.78 years as per the data of World Bank. This life expectancy rate has increased almost 10 years over the past 20 years. This indicates that more amount is required in old age or post-retirement period. And secondly, unlike other countries, other nations, India does not have a social security system and programs that will take care of retirements among many other things. As such, the individual has to take care of themselves and plan accordingly. Thirdly, the increasing health cost and inflation. The country's health costs have skyrocketed as the people's life expectancy has increased. Medication and hospitalization costs have increased, and also inflation has a negative impact on the savings of the individuals. Next is the regular flow of income. A pension or retirement plan ensures a steady source of income once you retire. You may then be able to live a more comfortable and peaceful life. And last is the tax benefits that are offered by pension plans. Purchasing pension plans at a young age is always recommended. This would also help you in saving your tax under Section 80C of the Income Tax Act. That was all for this video lecture. Keep learning, keep growing.